Well, a survey released by Ernst Young today indicates that although banking profits continued to fall in the first quarter of this year, they've certainly recovered considerably from their low levels of last year. And as a result, we've seen banking confidence improve somewhat from 24 index points in the fourth quarter to 45 currently. Emilio Pera, lead banking and capital markets director over at Ernst Young, joins us now for some analysis. Thanks so much, Emilio, for joining us this afternoon.
Good afternoon.
Well, quite a spike we've seen on a quarter-on-quarter basis there. So let's look at some of the fundamental support that the sector is receiving at the moment.
If you look at the index over last year, we have been at our lowest levels since we started with the survey 7 years ago. And that was largely driven by a lack of credit demand in the retail sector specifically, and also the high levels of impairments. That has clearly shown an improvement over the last quarter, where most of the banks have indicated that they are bringing down the credit standards, which would obviously result in more credit being extended, and that is also largely driven by the fact that the impairment levels are looking more positive.
Yeah. But to a large extent then, growth in confidence more of a reflection of people then pricing in that most NPLs are out of the system.
Yes, definitely. It's still at very high levels, although it is coming down from historic high levels, or highest levels that we had last year.
Well, does the same hold true for both the retail segment and the investment banking segment here? Are both segments experiencing this phenomenon on their balance sheets, or are there discrepancies?
In the investment banking side, it's largely driven through stockbroking activity. So private equity, trade and project finance is still quite slow, similar to the levels of last year. So in specific areas on investment banking, it is starting to improve. On the retail banking side, it is more a general improvement, where the banks are starting to extend credit and the impairment levels are reducing.
Well, with that having been said, if we focus in on the retail segment particularly, I mean, we're seeing that this is supportive of possible easier credit standards moving forward, where retail banks in particular are easing their credit lending criteria. And what do you make of this? Because are things necessarily that settled for them to be going down this route already?
I suppose if you consider the interest rate reductions that we had coming through during the course of last year, it is starting to filter through. During the results that we reflected last year, the question was, why aren't we seeing those? So it has been a good couple of months, and we would expect that would start filtering through, although it is at quite a slow rate. I think you have to keep in context the extremely difficult trading conditions in 2009. So we are starting to see that recovery, but it's not necessarily that it's a free-for-all at this stage. We're just starting to see that there is a relief in sight.
Do you have a view on where interest rates are moving going forward? Because as we were looking at earlier on in the show, we've had the Deputy Reserve Bank Governor say that, you know, if we do see the stronger rand at the levels that we see it now continuing to hamper monetary conditions moving forward, they could well step in and try and cut rates. Do you have a view on where rates are going?
Not a strong view as to where rates are going, but I suppose it is to look at the fundamentals at the time. If you look at the banking sector specifically, there's a lot of new regulation in the pipeline, and we would have to consider what the impact of that would be on the sector as such.
Of course, non-performing loans lending, just one arm to consider when it comes to banks and their revenue. We've seen also both interest and non-interest income gradually recover over the period. Which is happening or growing faster at this stage?
The survey that we do is more qualitative, so we can't necessarily see what the extent is, but it's, as you mentioned, a clear indicator that both of them are improving in a positive manner.
Yet we've got in this context, when it comes to sector trends, quite interesting trends that are developing. Retail banks continuing to shed jobs as they right-size their organization in an era of slower demand. I mean, do you see them then, with all having been said, them being equipped enough to handle the turnaround when it does eventually come to the fore?
If you look at the industry over the last few years, it has been a very tough trading conditions, and I think it is more as part of the long-term resizing of the market that it is still reflecting a reduction in staff numbers, whilst investment banking, where it's a much smaller headcount, has already shown that they are looking to improve.
Well, looking at it overall, I mean, banks' confidence levels still, despite this huge uptick that we've seen, they still remain significantly below that long-term average of 80 index points. So there's a large gap that still needs to be filled there. What's your outlook moving forward?
We do anticipate that, as I mentioned, depending on global trends remaining stable, that it would continue the improvement rate that we're currently seeing. It was at exceptional high levels through the cycle, but since middle of 2007, when the National Credit Act came into play and the global credit crisis hit us, it has been on a declining trend, and over the last quarter we've seen that it's starting to pick up, and that's been confirmed in the last results.
Any forecasts as to where this index could be possibly sitting as we enter the second half of the year, where we've seen in the past that traditionally the years have always been a tale of two halves?
If you look at the results of most of the banks and their expectations for the year ahead, it is that it would gradually improve as the year progresses. So the expectation is that there has been an improvement which would continue and hasten over the next quarter.
On that